Hello everyone, I'm Mark. I'm a CPA and accounting tutor, and today I want to talk to you about the perpetual inventory system. Okay, so let's first start out by talking about how inventory usually works. Let's say you're a retailer and you want to sell boxes. You buy those boxes from a wholesaler, and those boxes become inventory. They're not an expense. When you buy them, they become an asset. Inventory is an asset. When you sell those boxes, they're going to become an expense. Those are going to become cost of goods sold, right? Whatever you paid for those boxes, you now need to expense. You don't expense them until you actually sell them. Okay, so that's the basics of how inventory works. What we want to talk about is perpetual inventory system. And that is in relation to periodic inventory system. So there's two different ways. One's perpetual, one's periodic. So how do they work? Well, I wrote down an example here, and I'm going to talk it through because I think that's the best way to explain how perpetual works. Okay, so let's say on January 15th, you buy 10 items for $5 each. That's going to be $50 total, right? 10 times 5 is 50. And then on February 15th, you sell an item for $15. Okay, let's keep going. March, you buy 5 items for $10 each. That's going to be another 50. And then on April 22nd, you buy one item for $15. And then May 3rd, you sell another item, but this time it's for $20 each. So you'll see that the cost of your inventory is increasing over time, right? January is $5, March is 20th, April is 15th. In the real world, it doesn't really happen that fast, but the costs do increase over time, right? The cost of inflation or competition or something like that. So that's how it works, and as far as buying items goes. Okay, so perpetual inventory, that's a system that allows you to account for your cost of goods sold as it actually happens, right, throughout the accounting period. Periodic, which is not what we're talking right now, but periodic, you'll do everything at the end of the period. So everything at the end of the month or at the end of the year, that's when you're going to calculate cost of goods sold. You won't know it until the end of the year because you need to go back and calculate it. But perpetual, you're going to calculate it as you go throughout the period. So on January 15th, we bought 10 items for $50. On February 15th, we sold one item for $15. So right there, when we sell an item, we're going to calculate cost of goods sold. We know that we have $15 in cost of goods sold right then. And then March 20th, we buy some more items. April 22nd, we buy one more. And then May 3rd, we sell another item. So in this case, we're going to calculate some more cost of goods sold right here on May 3rd. So the reason I didn't put a dollar amount is because we're not actually sure. It depends on which type of perpetual you're actually using. So this is kind of confusing, but there's two types of inventory systems, perpetual and periodic. And then under each of those systems, we can also choose between FIFO or LIFO or weighted average. And you've probably learned about those before. In this case, I'm just going to talk about FIFO and LIFO, but know that you can use any other type of inventory system too. So let's talk about perpetual FIFO. So again, that stands for first in, first out. So let's go back to January 15th, February 15th. We know that right here, standing at February 15th, all we have is 10 items, right? We don't know that this March and April stuff, we didn't buy that yet. We're looking at just a point in time, which is February 15th. All we have is 10 items. So FIFO, we know that all we can do is sell one of those 10. We sell one item, we know it's going to be one of those 10, right? Because that's all we have. So we know that the cost of goods sold is going to equal 1 times the cost of that box. So I'm actually going to change this to $5 because it's 1 times 5, and that's the cost of goods sold, $5. So then we buy more items, and again we sell one for 20 now. So we're using FIFO, first in, first out. At this point in time, we have, in May, we have 9 items that we bought in January 15th, because we already sold one. And then we have 5 items we bought in March, and 1 item we bought in April. So we want to know which one of those items, one of the January, March, or April, did we actually sell? Well, if we're using FIFO, we sell the ones that we bought first, right? So when we sell this one item for $20, we actually sold one of these January 15th items. It was the first one we bought, right? So under Perpetual FIFO, we're gonna have $5 again as our cost of goods sold right here. So we're gonna have 1 times $5 from January 15th. Okay, so that's FIFO. Let's suppose we did LIFO instead, which stands for last in, first out. Okay, so let's go back. Let's delete these. We're doing LIFO now. So let's go back to February 15th. We sell one item. Remember, all we have is those 10 items there. We don't have these March and April yet. So when we sell one item, we know that it has to be from January, from one of those 10 items in January. So we know that we're going to take 1 times 5, and again, we're going to get $5 as the cost of goods sold for February. Okay, but then we buy more items, and then on May, we sell an item for $20. This time, though, instead of selling the first one we bought, we're using LIFO, which means we're going to sell the last one we bought. So instead of selling a January item, we're gonna sell an April item now, which cost us $15. It didn't cost us $5, it cost us $15. So the cost of goods sold under Perpetual LIFO in May is going to be $15. Okay, and then just as an example, just so you understand how this might be different than periodic, if we were doing periodic, let's say we were doing periodic LIFO, we wouldn't even consider what we had in February and what we had in May. We would just consider what we had at the end of this year. So at the end of the year, we would go back and say, hey, we sold 2 items. And if we're using LIFO, we'll say that we'll use the most recently purchased items, which is going to be 1 from April and then 1 from March. So we don't know that the sale actually happened in February. We just know that we made 2 sales throughout the year. But that's periodic. Perpetual, you will know exactly when you made that sale, and you'll know which items to then choose from. Okay, so that's a perpetual inventory system. Let me know if you have any questions. I'd be absolutely happy to help. If not, thanks for watching very much. I hope to see you again. All right, bye everyone.